Start streaming. Hey, what's up, guys? Today is, what is this? April, January, February, March, April. What the freak? 5th, 2016. Today's webinar is going to be about risk management. So, what I'm going to be talking about, I actually it's May. Oh, April, May, June, July, whatever. It's sometime in the year. Oh, it's May, yes. That's why everybody's selling and going away. Alright. So, anyways, you guys messed me up already. I just started. Yeah, so we're going to be talking about risk management. I feel like a lot of people are having issues with this very simple but very, very important aspect of trading. Risk management is so essential and it's so overlooked by many traders, and it is 100% compulsory to you being a successful trader. So the first thing about risk management that I think, like, I should head this up. I think I did put it on the notes. Yeah, it's plan the trade and trade the plan. Now that's a quote that's been thrown around a lot by traders, and a lot of people don't even understand what the hell it means. So plan the trade and trade the plan. It basically is what it is. It's you planning out a trade. By planning out a trade, I don't mean sitting there the night before planning out the trade. I'm just talking about in general planning out the trade right as you're doing it. Especially if you're a day trader, then you plan out that trade intraday, and then you stick to the rules. You trade the plan. So it's crucial that you understand how you're planning out a trade and how you're going to trade that plan. Okay, so I'm just going to be talking a lot because I did write down some stuff. So it's very odd that I write down things and I don't just kind of that I just don't just kind of wing it, but I actually wrote down some stuff. So sit back and relax. Um, okay, risk management. What should risk management actually do for you? Risk management should create value. It should it should be an integral part of your process, of your trading process, of your thought process. It should address and monitor uncertainties and assumptions, meaning that your risk management should in turn take away any assumptions that you're going to have about where price is going to go to, and any uncertainty as far as what you're willing to lose or where you're willing to see it go. It should be Risk management should be systematic and structured, meaning that it should be part of your trading system. It should be something that you adhere to in any trade that you enter. May it be like a $10 stock or a $50 stock. Your risk management at that point have to be the same throughout. It could be the morning time of the trade. It could be the evening time of the trade. It could be whatever. Your risk management have to be systematic and it has to be structured. That's why when I started, I mean, and I took it off just only the other day with all my rules and stuff just written down here. I actually moved it because I have too much stuff on my desk now. And by stuff I don't mean junk. By stuff I just mean trading computers and monitors and this Lego thing going on here. And so um, it should be systematic and it should be structured. It should be based on available information. Available information when you're trading is what's available to you. Your moving averages are available to you. The L2 is available to you. Your indicators are available to you. Your candle patterns are available to you. Your candlesticks are available to you. So it should be based on available information. Risk management should take human factors into account, meaning that's your wiggle room. Your risk management should take into account human factors, where if the price is going up, a human nature is not to go straight up, but a human nature would be for people to take money, called a pullback, a consolidation. So if you're short in something, a human nature, when the stock is coming down, it's not going to go straight one line all the way down. human nature would be for people to cover. So you would expect for the pops in between if you're shorting a stock. So a risk management should take into consideration human factors. And your risk management should also be periodically reassessed. Yeah, I said it right. I couldn't spell it properly, but I said it right. Alright, so it should be reassessed. Um, so, what I mean is that you're not gonna go change your risk management system every day or every week, but maybe like you know how when I say on Sundays that I review my charts and I review the trades that I took, that I before I open up any new charts, I go over the old ones that I do, and trust me, this one here today is going to be something that I'm going to really look at in a lot of details. I'm going to break it down in a 1 minute chart. I'm going to figure out what went wrong. I'm going to figure out exactly why such a trade actually got me today. And so this for me here is going to be a big learning experience this weekend. And so when I say it should be periodically reassessed, I'm saying that you should be able to tweak it. You should be able to tweak your risk management skills and make them better for you. Okay. I do have a lot of stuff written down. Okay. So, let's get into how traders actually mess up some simple aspects of risk management. So, take for example, a stock's gapping up in the morning, and there's I don't know, there's news about it or something, and so if a trader is following on Twitterville or something, everybody's saying that the thing's gonna go, from like say it's at $3, they're saying it's gonna go to $8 or something. So you automatically just take it long. And so the stock opens at 3, pulls down to 250. You end up buying more into the position. Why do you end up buying more? Because you're thinking that you're getting this great deal at a discounted price. So you're thinking that this $3 stock, that now you have a picture in your head that it's going to $8. You just bought this $3 stock and you're buying more at 250 because now you're thinking it's at a discounted price. You still have that misconception that it's going to 8 just by hearing other people talk about it. So, are you actually managing your risk at that point? You're not. You're just following somebody else's plan and not your own. So, you need to, a trader that does something like that totally broke rule 1, which is mismanaging his risk. And so him or her are gonna keep buying it until it goes down because they keep thinking that they're getting it at a cheaper and cheaper price, without thinking that it may not get to 8. They have that $8 stuck in their head so hard that all they're thinking is, wow, I'm getting it at 2, I'm getting it at 150, I'm getting it at $1. So they keep buying more. And so it's okay, Chris. And so their risk management just went out the window because of a concept that they have so locked into their head that it's going to $8 because of what somebody else says. So a lot of time your risk management itself gets thwarted by other people's interpretation of what something should do. So if somebody says that, I'm trading this $25 stock and it's going to go to $35, and if it keeps pulling on you, you're still buying it because somebody else says it's going to that price. Now, you're breaking all your rules to accommodate somebody else's interpretation of where this chart is actually going to go. So in that happening, you end up obviously taking a huge loss on a trade and or bag holding this thing for X amount of time. So we definitely got to work on risk management, and I'm feeling like I'm going to get into that a lot more right now. What do I have that's next? Ew. Yeah. Oh, okay. Oh, that works right into the other one. Okay, risk tolerance. So risk tolerance is personal. It's very personal. It's personal to you. It's personal to your account size. It's personal to how you trade. It's personal to how long you can hold something. It's personal to how much size you have in it. When I say that risk tolerance is personal, I mean that if you take something at $10 and you have a 50-cent risk on that stock at $10, it may be different for the person sitting next to you that possibly has a risk tolerance for $1 on that same stock. Now the difference is that that person that trades it at $10 and has a 50-cent risk, maybe that person has a better plan than you. Even though that trade may go against you and stop you out, it'll be better if you have a more solid plan than the guy sitting next to you with the 1 point stop. So he's actually risking 10% off that trade. So he's basically saying I'm willing to risk $1 on a $10 stock. So I think your actual risk at maximum should be 5% on a day trade. Maximum 5%. So if you take a $10 trade, you should be saying to yourself that I'm willing to risk 5%, which is 50 cents. So on a $10 trade, I'm willing to risk 50 cents on that trade, and that's how that'll work. So obviously, if it's a bigger stock, bigger price, you're willing to risk more. But that is your maximum. I think the superb amount is actually about 2-3%. That keeps it into a good range. 5% should be your stop, and 2-3% should be where you're already thinking, how am I going to alleviate this? Like if the price is going down, if the volume's coming out, if you see some other reasoning that, hey, like my stops are gonna get hit, don't wait for it to get hit. If you see reasoning to get out of the trade before your stops are hit, just get out of the trade. If there's strength in it and you're short in it, get out of the trade. You don't need for your stops to stop you out and then say, oh, I should have taken that 20 minutes ago. If you know that there's strength, there's a chart, there's its formations, indicators, everything is setting up for a move, and you're short and it's going up higher, you don't have to wait for that 5% maximum amount to stop you out. Um, so for me, I like to risk maximum 5% on day trades, and on swing trades, I like to risk a maximum of 10%. So, so I feel like on swing trades you should be able to allow for a little bit more pull and push because you're playing with daily candles. You're not playing with 5 minutes or 15 minutes intraday candles. So I feel like on a swing account you should be risking about 10 maximum, and on a day trade you should be risking about 5% maximum. I prefer to do about 2 or 3, and that's all mental, honestly. It really just kind of calculates in my head a lot more, and you'll kind of understand when I actually wrote it down today, and I was like, wow, there's so many of these things that I do intraday without thinking. It's become second nature, where when I put a stop, I know why I'm putting a stop, and I kind of already have a calculated amount of risk that I want. Like when I keep telling you guys it's a 3-to-1 ratio that I'm looking at, that's already calculated in sort of like a risk management type deal. So I'm willing to risk $1 to make $3. So it's always it's calculated in. Um, okay, so that. That's about percentages. Let me get into. Okay, so how do you manage that 5%, that risk, that tolerance? How do you manage that as a trader? Okay, so once you get into the trade, before you even get into the trade, you should have some sort of a stop loss in your head. You should say you went long into this trade right at that arrow. Okay, right off the bat, you should already have a stop loss already set, which would be the bottom of this with the candle. Okay, because if it broke the candle, obviously you want it to be out of the trade. Ultimately, you would really have to go all the way down here, but I think that would just be insane. So if you went long here, I would definitely have a stop down here. Now, if you went long here, at this point right here, you know that your risk in here and your target right off the bat is here. Why is your target there? Because there's moving averages there, and if you were thinking that that's where the price was going to go to, the reasoning for your profit target or your profit taken point, which would be over here, would be because of the resistances from the moving averages. Obviously, if you went long on the trade and your stop was here and the trade started to go up, you would take maybe 75% of the trade into resistance areas and hold some. Fortunately enough, it would have been one of those trades that exceeded any sort of goals, and it would have just been a monster win trade for you on the long side. But not all these trades work out like this. Not all moving averages just get slapped around like that. I mean, the 8, the 13, the 50, all of them just straight through. So not every trade would work out like this, but this one, for example, would have been perfect as far as like risk management. Okay, so stop loss is the price where a trader will sell or take a loss. This point takes the emotions out of the trade and prevents the "I hope it'll come back" mentality. So stop losses should be where a chart breaks support or trend. Okay, so for example, let's do Nugget. Yeah, I traded Nugget today. I went short on Nugget at 103 it opened. I shorted pre-market too, but then I went short 103 at the open. Okay, so, and I really caught the top of this thing. Um, so for me, when I took the trade, I already had all these lines out here pre-market. Some of my lines are on here for weeks, for days, and so when I took the trade at 103 here, I actually knew right away where my risk was. I knew that I was gonna risk a couple points to the upside, and that I would be looking for a much bigger move under this area to the downside. So even as I was getting into the trade, all of this stuff was already kind of calculated into my head. Couple reasons why I went in a little bit earlier on the trade, and I was not willing to let it go all the way up to the resistance area, was because over here, this volume bar right here just started to die out. So the volume that was coming in was less than the previous volume, signaling to me that the buy-in pressure was already weakening out at the top. Couple reasons. Right before when I actually entered into the trade, see this little top right here? When the chart came up to it again, it nailed it to a penny right here, and then it quickly pulled back. So for me, when I saw that, I instantly said, there's sellers up here. There are quick sellers up here. And so I already had it in my head that I was going to short the stock. So knowing that I was going to short it was already okay. That's me. That's me interpreting that I'm taking the trade for sure on the short side. Now figuring out where I wanted to take the trade on the short side was already here, because I have a trend line. If you do it on a 15-minute chart out a few days, you'll see that that trend comes all the way down here. So being that I already knew that, okay, let's get this back here. Being that I already knew that I was going to take this trade short, all I had to do was assess a couple things. Assess where my entry was going to be, and assess what kind of risk I was willing to take. So I already had a price target area, okay? I already had a resistance area over here. So for me, just getting into this zone here, and when I take a long position into what I call a power zone, is where the trade actually changes direction. And so for me, into this resistance and over this area here, for me was power zone over here. So as soon as it got into power zone, I kind of like even numbers, so I just hit that 103, and I literally caught it on point, and it never looked back from there. I had a stop over this trend line here, and this is what I usually call my holy shit stop. It's just far off enough where I'm willing to say, wow, I can't believe it went up there, but for me to still at least walk away with my shirt, and so me being able to be alive still. So what I did when the trade popped over here and I went short, instantly put my stop in over that trend line, because if that trend line's broken, you gotta understand that the trade actually breaks a multi-day trend to the upside, and that's dangerous if you're a shorter. So for me, stops over this way here, that was a must. So I knew right off as soon as I got into the trade a few things right off the bat. First thing, I knew where I wanted to take some money. Secondly, I knew exactly where my stops were going to be, and I automatically knew where my add point was going to be. So anyways, entry, stop, first area for profit taken. Now, why do I always tell you guys to take money? And this comes into the taken profits point. Okay, so let me read what I wrote and then I'll explain that. Taken profit points is where traders should take profits into resistance areas, avoiding complications and possible collapse of the entire trade. Okay, so when I say that I'm always taking money into, if I'm long or short, in this case I'm short, taking money into support over here would have been here. Okay, so I took some money into this trade here. So after I did that and I achieved my first goal, once the price broke under here, and not in this candle, but on the retest, that's when I took it. On the retest candle, added into the trade for more short back to the downside. And so obviously there's a lot of things that I do sometimes intraday that I can't show you guys unless I'm on a live screen with you guys. I can't really like explain every single point, and then sometimes even if I would literally have to be sitting there sharing my screen with my trade and explaining only one trade at that time for a group of how many people that we have. So it would be really unfair for me just to be walking through this trade exactly, like point after point, as to where I'm taking, where I'm expecting it to go, where I'm adding. It would be nice. I mean, if you really think about it, it would be nice for me to say, hey, I'm thinking I'm going to take here. It's because the volume dipped. It's because I hit a double top and got quickly rejected. It's because I have a resistance area. What am I looking for? I'm looking for here. I'm looking for an add on the retest to this area. It would be really nice if we can go through that day, you know, on a daily basis, just one-on-one like that. It would be really nice. But you know, it's just that everybody has something else that they're trading too, or something else that they're looking at. So you never really get the entire feel of the trade, especially when I'm just saying, hey, I'm adding here, or I'm taking some money here, or I'm looking for 50 cents here. Like I have those targets kind of mapped out in my head already, but for you, just me typing it in doesn't really get you the entire understanding of why I'm taking money here or why I'm adding here. So hopefully after this webinar you'll kind of understand how I assess these things, and then you'll kind of feel where in the chart that I'm looking to add, or and then you'll see maybe, hey, I saw where you're looking to add. There was volume, or you added on a long position because it broke through a resistance, and so you'll try to understand these things a little better, and then you'll try to figure it out in your own trades. Okay, so we did the stop loss, we did the profit taking points. Oh, okay. So choosing risk factors. I really did write some good stuff down. Choosing risk factors for different types of stocks are very important. Volatile stocks like ETFs use wider stop ranges, reducing the chances of being caught into whipsaws. Tighter stops can be used into direction for maximum money. Okay, so let's go over the first one. Choosing risk factors for different types of stocks. Okay. in a trade like an ETF, or like if you're trading gold, for example, like I am with Nugget here, um, you have to have a wider range for a trade. You can't trade something like this. If I did 5% maximum loss on $100 stocks, it gives me an average of about $5 or so. Yes, right, somewhere around there. Gives me an average about $5 on a stop. Okay, that's maximum risk. I was willing to risk up to this line, which actually puts me at 103 to 105.50. It's actually 2.5%. So two and a half bucks. So it actually puts me right in that 2 to 3% that I actually like to trade. Now, did I sit there with my calculator and say, hey, I'm gonna risk 2 to 3% on this trade? No. But did I end up just falling right into that bracket? Probably very close to it. So without actually, and that's just me doing it all in my head in like a split second. So by me doing that, I kind of put myself into that range where I'm willing to risk. The maximum is $5 on a $100 stock, and it actually gave me a $2.50 risk over here. So it puts me at a, what is it, like a 2.5%, which puts me directly within the 2 to 3% that I want to risk on a day trade. So by mathematically figuring it out, it's like, wow, that's kind of perfect. But I didn't do that when I was trading. You can't do that when you're trading. It's not something that you can work out so fast. But when you get to a certain level in your game, you'll understand that it kind of falls into place, and that you'll see what you're risking, and you'll understand why you're risking so much. So, um, choosing risk factors for different types of stocks are very important. Okay, so like volatile stocks like ETFs, like UVXY, TVIX, DWTI, those types of things, the ranges have to be wider. If I always tell you guys in in chat, if you can't trade something like this with me with a wide stop, don't bother. If it's something that you can only have a 50-cent stop on, don't bother. And it's not that I'm telling you that because I don't want you to make money. I'm telling you that because there's a certain risk factor that goes along with every type of trade. $100 stock, you have to understand that you're willing to risk 2 or 3 points. So you cannot be saying that you want to trade $100 stock and be willing to risk only 50, a dollar. You can't be willing to do that. I would say that the only way that you can somehow do a tighter stop on a bigger trade like this is if you're playing a double top. If you're playing a double top, for example, if you were doing a double top here, and this double top sits at 102.40, if you shorted at 102.40 right there to the penny, you would have nailed that in that 5-minute time frame. You would have nailed that trade in that 5-minute time frame. But in a couple minutes after, it would have blown through. Now, if you were nailing that trade at 102.40, whatever it is there, say you had a 50-cent stop, you would have gotten stopped out. It would have gone to 103.33, stopped you out for your 50 cents, and then do this on you, and that would be heartbreaking. So what I'm saying is that you have to choose your plays. You have to analyze your trades. If you have an account that you want to hold tighter, is it be that it's smaller, being that you're less of a risk-taking person? If that those are the factors that you trade off of, you have to understand that maybe something like in this range with this sort of volatility isn't the trade for you. So that's part of your risk management. So if you understand that you cannot be willing to lose, say if you did 100 shares of this, right? You have to say that you're willing to lose a certain amount in order to, you're willing to lose $200 to $300, right? If you're doing 100 shares, you're willing to lose $200 or $300 to make, whatever your risk is at that point, whatever your price target is at that point. So if you cannot lose $200 or $300, right? Because remember, your risk, you're always assessing that that's what I'm willing to lose, right? So I'm not saying that that's what I'm going to lose, but that's what I can afford to lose on this trade. So if you cannot lose $200 or $300 on a trade like this, you have to step back and you have to say, my risk management does not fit into this trade. And it's okay. It's totally okay to, yeah, we can go into that. So my risk management would allow me to get into this trade because there's a certain bracket that I want to be willing to risk at for the day to make a certain amount. If you want to make $300, I think you should be risking about 150 in order to make that $300. If you want to make $3,000, you have to be saying, I want to be willing to risk $1,000 to make that $3,000. And that $1,000 risk doesn't have to come with one trade, but it has to do with the cumulative amount of trades that you're taking maybe for that day or for that time period. So if your goal is $3,000, you have to say that you have to be willing to say, hey, for this $3,000 that I'm willing to make, I'm also willing to lose 1,000 in trial and error trying to find those trades that I want. If you come in every day and you say, I have a $3,000 goal that I need to make every day, but I'm not willing to lose $500, then your risk management's all screwed up. And either you break down your daily goals, or you understand that you better be a precise killer on the trading floor, because it may get dangerous for you. So make sure that your risk management is appropriate for the amount of goal that you want to hit and the amount of money that you're willing to lose, and make sure that it is appropriate with the stocks that you're actually trading. Okay? So, a flowier stock, for example, something that is less volatile. Let's take a look at, say, let's take a look at, I don't know, one of those regular ones. Okay, I did HB today. Okay, something that was a little less volatile, something that won't whip 2 or 3 points in your face, right? The AI gave a short idea here at 61.40 something, somewhere around here. Okay, the fact that assessing this trade right off the bat, you know how I like to deal with opening range, okay? This area here is your opening range. If the price breaks out of opening range, which is 1, 2, 3, 4 candles, 5-minute chart, 4 candles, 20 minutes altogether, opening range, okay? If your chart breaks out of the opening range, either to the upside, you go long, to the downside, you go short, okay? So in this case, the AI program actually gave a short into this candle here. So it probably could have been from the sell-off volume rather than when it broke over here from that buy-in volume. You understand the difference there? There's a huge difference here, okay? Into this break and this break. There are buyers here and there are sellers here. So there's a big difference when it came through over here. If they were supposed to support it over here, this candle would need to be just about the same as this candle in order to hold that double bottom. So in watching your volume, you can tell instantly what kind of people are sitting here. What's the mindset of this guy here? Is this guy willing to buy more shares to take it up higher, or is this guy willing to sell his shares? Okay, remember, it's just, these candlesticks are just a graphic depiction of what people are thinking. Okay, so this guy here is saying, I'm done, I'm not willing to buy more, because when I bought a ton over here, it didn't give me a move. So if I'm sitting over here at the same place I was at when I bought a ton before and it's not moving, I don't care to buy more. So he's basically saying, I'm willing to sell. So opening range breaks, you take the trade short. Okay, I would possibly take the trade short, not into this candle, but possibly into one of these two candles on a way to up test the trend here. Okay, reason why I would take the trade possibly into this candle is because obviously you can see that it retested the 8 EMA there, and that for me is a good rejection signal. If I took that trade short right there, automatically your risk zone is set here. But I wouldn't have a risk zone set there. Why? Why would I not have a risk zone set here? Because not only do I have the 8 EMA, I have a 13 EMA, and I have the big boy 50 EMA sitting over here. So my risk would be set somewhere over here, over the 50 EMA. Ultimately, sure, you would like your risk to be over this trend over here, but I probably would not even take a risk that high because I have so much resistance right up into this zone over here. Remember, not only does your chart have now resistances from the moving averages, your chart actually has resistance from the opening range that it just broke out of. So that opening range support now becomes opening range resistance. So you can actually have a pretty tight stop, but being that, say you took the trade short at $61.30 right into this range here, $61.30, you know that your risk is up here to about $61 and say 75 cents. Okay, so what are you risking there? 45 cents, right? So your risk here is 45 cents, which puts you really good. So if you're risking, let's take an average, let's say 50 cents. If you're willing to risk 50 cents right off the bat, you're telling me, if you're telling me, hey Barry, I'm willing to risk 50 cents on this trade, then I'm going to be responding to you, okay, so then you're looking for $1.50. Okay, fine, because it's a 3-to-1. So you got in here, you're risking 50 cents to here, and you're telling me that you want $1.50. So 61.30 to 60.30, that's $1, and 50 cents on top of that puts you into 59.75 or something like that, and that's your 150. Okay, so this would be a perfect risk reward trade because first of all, you got short because it broke out of opening range. Not only did it break out of opening range, but it broke out of opening range with sellers, not buyers. There's a whole big difference in these two candles right here. This is a hammer at the bottom with strong volume. These are buyers. This is nothing. This is just a sell-off candle. This is a sell-off candle with sellers. So this is a whole different candle right here. When I'm playing opening range, do I consider news? Nope, I don't consider news at any time unless it's a parabolic into news type deal. I'm pretty much 98% technical, and the news that I trade is just it's really honestly it has to be. Most of the times, as far as news go, the volume usually comes in before. But as far as to analyze the news itself, honestly, there's nobody really faster than Wall Street Warrior. And so if he tells me, like I like something or I don't like something or I'm long something, I'm going with that. So he's my go-to news guy. As far as everything else, I'm a technical trader. So opening range for me is very important. It's a factor into direction. It's a strong resistance or a support range, and I think I went over this in last webinar or webinar before that, how important opening range is to me and how important opening range can be to you. And I actually had a lot of traders that I think Spartan it was that used opening range the next day on something, and actually it turned out to be a really good trade for him. A lot of people don't understand how important the opening range actually is, but it's pretty important. So anyways, I'm getting a little carried away from the actual webinar. So okay, so that was choosing risk factors. And I think, oh yeah, I only have a couple more things I wrote down, and then we're all done with me actually talking about what I wrote down. Last thing is potential risk management treatments. Complete avoidance of the trade in general is one reason to avoid any sort of risk into a trade. What I'm saying is that When I pointed out to you how if DWTI at a 4 point risk or a 3 point risk or something like that does not work for you, that is avoidance, and that is okay to avoid a trade. It's okay to say I can't trade that. Yeah, it's okay to say I don't want to trade that. It's your choice. It's your decision. It's your account. It's your money. It's you saying I cannot lose X amount of dollars, and so I cannot risk X amount of dollars. I cannot see something go 2 points against me. I cannot see something go 75 cents against me, a dollar against me, 2 points against me. You have to understand that this is your trading account. This is your job. This isn't anybody else's job. Nobody else is gonna come and just slap you with some money after the day's done and say, "Oh man, that sucks. Here's your 10 G's that you lost today because you didn't manage your risk properly." Nobody's gonna do that for you. So if this is something, if you're this is something that you're doing for real and something that you want to build a career out of, you have to understand that you have to have money at the end of the day to trade the next day. So you need to understand your risk. If something that's trading way too high in your price bracket and you just don't want to do it, don't do it. If it's trading too low and you're feeling like, hey, that sounds kind of OTC skittish to me, and I don't feel like playing it, don't play it. So avoiding a trade completely is the first treatment to any sort of risk management. Okay, avoiding may work, fine. But maybe you want to play the trade. Maybe you decide that it's okay. I can manage something going against me for X amount of points or dollars or pennies or percentages. And so you're saying, okay, I'm willing to do that. But what I'm not willing to do is I'm not willing to go huge size. So reduction in share size is going to help you to manage that risk factor. So you're not avoiding the trade completely. And by the way, not avoiding the trade completely doesn't make you any less of a trader. It doesn't make you a scared trader. All right, it makes you a safe trader. Okay, it makes you that guy that's going home with the same amount of money he came in with, and which is okay. All right, trust me. If you talk to a lot of traders out there, sometimes a flat day is better than a red day. Okay, and you don't want to learn that the hard way. So avoidance is the first. Reduction in share size is the second. So if you still want to play something, play 50 shares, play 100 shares, play 10 shares. You know, you can still get into a certain trade, but make sure that you reduce your shares so that if you're willing to lose, remember, if your goal is $300 and you're willing to lose $100 to make that $300, you have to make sure that trade, if you have to risk 2 or 3 points on it, you have to make sure that 2 or 3 points doesn't add up to more than $100 in losses, because that would exceed the amount of money that you're willing to risk for the amount of money that you're willing to make. So now you don't have to sit there to calculate on a pen and paper and figure this out before you get into the trade, but you have to have a general understanding of, hey, I'm willing to get so much and I'm willing to risk so much, and if these things don't add up, that formula just won't work. So that's the second way that you can treat any potential risk management situation. You can avoid it. You can reduce your shares. You can outsource, and by outsource, I'm saying you can ask somebody for their input. You can say, hey, I mean, that's why you guys are in a chat room, because you're there to get information as far as, hey, maybe I'm seeing something from one way, and maybe I feel like I can ask somebody else that maybe can see it from a different angle. If you were 100% right on every single angle that you have, you wouldn't be here, first of all. I'd have zero people. I'd be talking to my glass of water, and and you guys would all be billionaires. So none of us, including myself, I like to ask people too. I ask people all the time. I say, hey, how do you think this looks? I mean, like, I have people I talk to myself. And so you have the opportunity, that's why you're in a chat room or you're associated with people that are traders, and that you have the opportunity to sort of, share ideas, bounce things around, see how see what sticks. If you say, hey, I like this here, and I'm looking at it, I'm saying, hey, that looks kind of bullish, I may be saving you some money. Sure, I may be wrong too, but if you can get a different angle of the view, if you're looking at maybe at a 1 minute chart, and you're looking at maybe a small section of your trade, right? You know that cool feature on TOS that lets you highlight that area? It's really nice when you're looking to define a trade. It's really horrible when you look back on the day and you go, wow, I didn't see that resistance right 20 minutes ago, and that's scary, right? So maybe I'm looking at my trades on a 15-minute chart. Maybe I'll be able to see a support 2 days out, and you won't be able to see a support 10 minutes back. So, asking somebody, hey, take a look at this for me, see if it's different from what I see, and it can really different, help you manage your risk, right? So it's just like sitting at a desk in an office, and then you can't figure out some program or something, and you reach over to the person next to you and you tap them on the shoulder and you say, hey, can I get your input on this? It's the same thing, all right? It's just, I mean, obviously this is our business and this is our office, and you just reach over and you say, hey, can you just take a look at this for me? So that's another area to manage your risk as far as getting a treatment for it. Retention, which basically means you're gonna accept whatever happens on the trade. You're a trader that wanna take something at $35 long, and it's going to 33, and that should be your 2 to 3% loss there, and you're saying, I don't care, and you let it go to 30, and you say, I don't care. So that's retention, that's accepting, that's not budgeting, but basically you left the entire field of risk management there, and your risk management is basically, I'm long no matter what happens. So you tie that into the emotion called pride, and you get a really nasty thing called no account. So you have to be able to say to yourself at some point that this trade is not working. I've hit my 2 to 3%, and that it's not as much as I want to lose. I want to lose 5 to 6 to 7%. So you're saying to yourself that I'm willing to lose as much as I'm willing to lose, as much as I can able to lose 50% of the trade, 60% of the trade. I'm willing to lose as much as I can lose because I am sure that I'm right. So pride is a really really bad emotion that you want to take away from your trade, and you want to be able to say, I had a red day today. I had a bad trade today. That trade that I took was totally wrong. You have to be able to admit that you're wrong. But not only are you admitting that you're wrong, if somebody says to you, okay, so you were wrong, what did you do to prevent yourself from being wrong? You had a stop in. Yes. How much did you take? 2 to 3%? I stopped out at 5% because that's all I wanted to give them. And that right there, if you told me that you took a bad trade and that's how much you lost, that's the first thing I would probably ask somebody. Hey, you took a bad trade. What did you lose on it? What was your daily goal? What was your strategy? What was the reason for getting out? What was the reason for getting in? So I want to know all the factors first before I can even help you understand, hey, where did you go wrong? Sometimes I'll see somebody's bad trade, and I will tell them that is an absolutely perfect trade. I don't care that you lost money. That's not the fact. The fact is that I will tell a person, even in a red trade, that was an absolutely perfect trade with a perfect setup and a perfect risk management, and the trade didn't work, had nothing to do with you, and that you're still an awesome trader for taking that trade. And I've told many people that with as far as some of the charts that they would send me, and they're like, "How did this not work?" And I'm like, "They just did not like you that day, 'cause that's a perfect setup." Um, I'm not afraid of losing money, and neither should you be afraid of losing money. But make sure that you have your risk set, okay? And and my last notes here. Well, it's not really a note. It's just my last advice to everybody. Use holy shit stops if you are one of those traders that that takes your position. And I use holy shit stops all the time, because sometimes for the very second that I take the trade, I feel like I want to maybe let it go a little bit more, or let it pull a little bit more, and I don't want to be able to. I trade a lot of ETFs, right? So I do have a lot of those wide stops very often, because I feel like I don't want to just get stopped out on a quick whipsaw type trade. And so for me, I usually have, as soon as I enter the trade, if I don't have a predefined area already, I'll put a really wide stop just in case. Just in case. And then while I'm working on, I mean, it'll take me a couple seconds to just figure out exactly where I want the actual stop. I'll have an idea of where I want the area or the range of the stock, the stops. But in order for me to put an actual number into the thing, I'll just put a wide stop just in case, and I just call that my holy shit stop. And so that's my last notation that I have written down. And so that's pretty much all I got to say about risk management. So make sure that you analyze your risk, and you understand how much you're willing to lose on a trade, how much you're willing to wait to how much you're trying to make on the trade, and understand that your account is not everybody else's account, and don't try to trade somebody else's account with your account. Okay, don't see somebody making X amount of dollar and try to make X amount of dollar with your account. Trade what your account is willing to give you. Okay, because if your account is $5,000, you need to understand that you have a $5,000 account. You cannot be willing to trade 1,000 shares of DWTI with a $5,000 account. It's just not gonna happen. You have to be realistic about a lot of things. A lot of people are not realistic about a lot of things. A lot of people are not realistic about daily goals. If you have a smaller account, you have to understand that your daily goal is not going to be $1,500 a day. If you're trading for 6 months, you have to understand that your daily goal should not be more than $500 or $300 a day if you're trading for a short period of time. So sometimes there are things that will make you a better trader from the get-go, and that's the way that you want to get in. You want to be sure that you're able to understand all the factors that will make you a better trader, not today but in the future. And if you don't have money in your account, you won't be able to accomplish that, no matter how good you are. Because if you can't trade, you can't trade. You can make tens of millions of dollars on paper accounts, but if at the end of the day you don't have physical money to trade, you can't trade, no matter how good you get. So, anyways, I'm gonna stop recording. Hopefully that was helpful.